Best ever listeners, welcome to the best real estate investing advice ever show. I'm Slocomb Reed, and today we are joined by James Bohan. James is joining us from Coeur d'Alene, Idaho. He is a CPA as well as a real estate investor. His firm, Stonehand, his CPA firm, advises real estate investors on tax efficiencies and helping them deliver timely K-1s. He also works with his family's family office. He's a fourth generation real estate developer, and he's the CFO of Exodus Development, which is a modular construction development company with over 200 multifamily units currently in development. James, can you tell us a little bit more about your background and what you're currently focused on?
Yeah, thanks for having me on the show, Slocomb. Excited to be here on the Best Ever podcast. My real estate experience has really been there my whole life. As you mentioned, I'm a fourth generation real estate developer. I learned about cap rates, financing, tenant management, construction at the dinner table my whole life, growing up with my father who developed some homes in multifamily in Las Vegas. Growing up from there, I went to college at USC where I majored in accounting and real estate finance as a specialization with a business degree. I graduated when the world fell apart the last time in 2008, so leaned on my accounting degree, went and started my career as a CPA. That's where I started to see how the real estate industry was evolving to a more institutional level asset class where people were starting up these funds, that this alternative investments idea was being thrown around a lot. The firm I ended up with was great and a specialist in this called Rothstein Cass. They were a premier boutique accounting firm for hedge funds, private equity funds, and given my background, I slotted right into the real estate private equity fund department. So I cut my teeth doing that, seen a lot of deals that went bad through the last cycle, saw how some of the players were running the game now, raising billion-dollar funds, and basically having a leveraged bet on inflation with a 2 and 20 hedge fund model. I realized this is where the future and where I wanted to be. So when the firm merged or got bought by KPMG, I still worked for KPMG. I went to get my master's in real estate development from USC. Through that time, I got hired by one of my professors who was starting a real estate debt fund. I onboarded as the first employee and CFO, saw over $1 billion of loans across my desk as I was there, onboarded over 1,400 LPs. Towards the end of Q4 2018, there was just some style drift and didn't like where the firm was headed. Parted ways in 2019, started up my own CPA firm. That's when I started working with my family to do some investments. I moved to Idaho in 2020. That's where kind of the real estate portfolio personally that I was managing and owning took off. Up here in Idaho, I have a single family rental. I live on a 10-acre farm that we run as a market garden. And with the family, we bought an old 7-key motel that was really run down, and through both physical and operational value add and repositioning, we turned it into a 10-key boutique lodge and event center. You can check it out, lakevillagelodge.com. We're hosting people up here in Coeur d'Alene, and we've just had great success with the market out here.
Give me a second here. An underperforming 7-key motel seems like a pretty tricky place to investment to execute on, both the size, frankly, because it's small, but also that's a much more complex business model than a lot of things. Tell us how that went.
That's a really good question. So we didn't set out to do this. When we first bought the property, we viewed it as a covered land play. We were hoping that the motel would just cover the taxes, interest. We didn't have debt at the time. Or sorry, and once we brought on debt, cover the interest as well. And the insurance, that was the other I word I was looking for. So we were planning to demolish this and build 100-room or hotel or apartments. Going through due diligence, we saw that the market wasn't quite ready for that. There was something going on in the actual sub-market that wouldn't make development feasible at this time. So after running it only on Airbnb for the first year, just trying to get some cash in the door, That's when we added 3 more rooms. That's when we did the operational value add. There is so much technology out there today where you're able to run some of these lower key hotels with efficiencies of a bigger hotel. For example, AI has brought in a lot, and one job that it's replaced for sure to a large extent is revenue management of hotels. There's a ton of AI softwares out there. We're currently working with a great company called Lifehouse that also does management for boutique hotels. But I've been through a few of these, and they just take the trends, picking up what's searched on Google, looking what's happening at the OTAs such as Booking.com and Expedia, and using AI to build out a price forecast that also adjusts daily or hourly, even in some cases, to really meet the demand of what people are searching for in these markets to buy hotel rooms.
James, at the beginning of that explanation, you used a term that I've never actually heard before, but makes a lot of sense, especially the way that you described it. You called it a covered land play. And I imagine that means that you were buying it for the value of the land for future development. You hoped that development would be immediate, but you saw that there was still value in holding the land long term, as long as the expenses of holding the land were covered land play. That makes a lot of sense. Tell us more about why you thought a covered land play in that part of Coeur d'Alene, Idaho made sense.
The asset is really prime time. It's right by the resort's golf course here. There had been a lot of blight in the area that had been removed over the past 5 to 10 years. So a lot of the locals still might have had not their complete eyes on this and might have thought that the area was still a little dilapidated. There's only one site left that is still, I'd say, underperforming that needs to be brought up to the neighborhood aesthetics. But we did what we could with fence screening, visual screening in order to really separate our property from the rest. And that is, sorry, you're going to have to cut this out. I just blanked on the second half of your question there.
The question was, why does a covered land play make sense right now in this area?
Gotcha. So the other reason why we really covered land plays here in Idaho and Coeur d'Alene is Idaho is one of the fastest growing states in the country, and Coeur d'Alene is one of the fastest growing submarkets as well. If you look at some of the property market values over here over the past 4 to 5 years, it's just really increased exponentially. And I think in 2020, 2021, there was about a 25% growth here in just our submarket. So it's a really desired area to be in. And we just saw, land values going up in the future. We obviously wanted to develop it if we could. But going through this process just really helped me understand how amazing these boutique hotels can be in this market, both just macroeconomically for a lot of economic reasons, but also in microeconomically in the submarket where I am in Coeur d'Alene. It's a very tourist-focused industry town. So in the summer, we get a lot of lake activities. In the winter, we get a lot of skiers. So we can capture a lot of that all around the year, seasonal tourist and hotel guests with our property.
So it's more of a cash flow play now that you've had the opportunity to execute on a value add business plan.
Exactly. And with this covered land play idea, and it's evolved to this value add cash flow play. To carry on with your last question, a lot of the macroeconomic factors that I love for hotels is that, like I said before, you can reset your price daily and even by the hour or by the half an hour. When you look at other asset classes that have to reset their prices in a high inflationary environment, it's harder for them to really meet where the market is. If they sign, like for office, for example, they're locked into a 10-year lease. They might have certain clauses of escalation, but you're guessing at what inflation is going to be in the future unless you tie it to a CPI percent increase. Retail, those are usually 3 to 5 year leases. Even multifamily, that's a 1-year lease. So if inflation really takes off and your market rents are at the start of the lease are, call it $2,000, 6 months later, the market rate could be $2,500. When we're in this really hyperinflationary or stagflationary environment, I really like this hotel asset class for that reason of being able to reset the price daily. Second to that, since we are in this high inflationary environment with rates being higher for longer, we're able to get positive leverage on the going in cap rates or stabilized cap rates on some of these assets. I have a pipeline of about 4 hotels I'm looking at for our hospitality fund, and going in cap rates for ones with decent P&Ls are going to be in like the 10 to 12%. We can borrow between 6 to 7%. So that's really hard to get in the multifamily world, where you're going in and buying things at 4 to 5, sub 6 caps, and you have to go and put negative leverage on it. That's just something as an investor and as someone who's grown up in real estate for decades, buying stuff with positive leverage buying things with negative leverage is speculation, not investing, because you're really banking on rent growth, which, is probably going to happen. But I like going in on the front end knowing that I'm going to be able to cover my debt service on a totally positive leverage basis.
Yeah, that makes sense. And it's not a trendy time for sure for finding cash flow in multifamily for a handful of reasons. I'm based in Cincinnati, Ohio. There are still deals out there being brokered that cash flow. We're a Midwestern market where demand continues to outpace supply, even though both are growing slowly. There's still a delta between them. I get what you're saying there. When it comes to, I want to put one more pin in the covered land play. Being that I'm here in Cincinnati, the closest thing that I've seen executed on well in that regard, where it's not necessarily an entitlement play where you're planning to sell to a developer as quickly as possible, is that there's a lot of new development going in the Interstate 75 corridor between Cincinnati and Dayton, where a lot of it was farmland 10 and 15 years ago. That farmland is now subdivisions, trendy suburban subdivisions. I know that there are investors looking to buy up that land, but that's not necessarily what you were calling a covered land play. Let me take a crack at this, and then you tell me where I'm right and wrong, and then we'll transition the conversation. A covered land play, which is really a long-term land play, makes sense for investors who are capable of deploying capital for a long time without seeing significant return on it, because of the expectation that the returns will be very high when they decide that it is time to sell that land, that real estate. It's a covered land play when the real estate itself is capable of generating the revenue that covers its expenses, which mitigates your downside risk by mitigating your carry costs.
That's exactly correct.
Cool. Yeah, that's an interesting term. It makes a lot of sense. And it's something that I know that there are listeners who will be interested in, who will want to look into further the prospect of long-term land plays where you have your downside and your carry cost mitigated by buying something that is revenue producing, even though it's not currently the highest and best use of that real estate. That makes sense.
Exactly. And to your other point, though, when you're talking about people going up buying the farmland, I think of that more as land banking. I'm not sure if
Sure.
all the farmland is going to be able to cover the carry costs, but with those strategies, you can get into some advanced tax planning things too, where developers, if they're going to sell single family homes or things that are going to be dealer property, you can use some tax strategies to own some of the land banking in an S corp, sell it to your developer co, capture your capital gains that way, and lock in a lot of profit that way. It's very similar to what people do with transfer pricing. And then the dealer, the guy actually building and selling the homes, they do it for a marginal profit. So this is with land banking, you can get into a strategy of turning a lot of the profit of home development into capital gains.
Yeah, that makes sense. A second here. James, tell us more about what attracted you and your family office to Coeur d'Alene, Idaho.
It's a story that's pretty common these days. We were a pandemic move. We looked around the mountain states of Utah, Wyoming, Montana, Idaho, and just for a confluence of factors, Coeur d'Alene checked all the boxes for my family. There's a lake. Coming from Southern California, we were really into boating and boating culture. So there's a lot of that to do around here. There's golf courses. The people are some of the friendliest people I've ever met in the world. And just moving up here, the first time I went into my home, I walked across the street and there was a wedding venue that hosted beer nights out there, and it was just a sunset overlooking the whole valley. They had a Celtic band playing. I'm Irish, so I just felt really at home at that point in time, and I love it here in Idaho, and it's really hard to get me to leave.
That's very interesting and very much not where I thought you were headed with that answer. When you look at, I don't know if you would call Coeur d'Alene an MSA, but when you look at it as a market for investing in, what are the economic drivers that make it a good place for hotel investing right now?
It's a good question. When we look at Coeur d'Alene, we're part of the Spokane MSA. So Coeur d'Alene is located in Kootenai County. There's about 100,000 people just in Kootenai. In the greater Spokane, Coeur d'Alene MSA, there's over 1 million people. Like I said before, this is one of the highest growing cities in one of the fastest growing states in the nation. And there's just a lot of turnover, people looking to move up here, need a place to stay, people coming for summer vacation, need a place to stay. So I just think being carried and lifted up by this massive movement in the market is going to lift all asset classes, especially when it's such a desired tourist location for people to come and enjoy the lake, enjoy getting out there on their ATVs, enjoying a lot of the outdoor beauty that is here in Idaho. I think that's going to lend to a lot of the demand for hotels.
If I could summarize, the demand for hospitality amenities far outweighs the supply. And so what you're recognizing there is that not only coming from Southern California, not only are there people from places like Southern California who are looking for places like Coeur d'Alene, but the proximity to Spokane also makes it compelling in that it's a much shorter trip for a larger population that's just close by.
Exactly. I tell people it's like Los Angeles is 45 minutes away from Newport Beach in Orange County. It's a very similar commute out here. There's a lot of people that live in Coeur d'Alene, that work in Spokane, and make that 30, 45-minute commute every day. And so it leads to a really good, strong, and resilient ecosystem of just everything you need from a good city.
Tell me I'm wrong here. You said Coeur d'Alene, Idaho, and your family moving there from California. And my immediate thought, in part because you referenced it, was that Coeur d'Alene, Idaho is is a COVID bump market that got really compelling when people were looking to get out of major metros that they are now in the process of moving back to. Are you not seeing those kinds of more volatile market factors? Has Coeur d'Alene seen consistent growth since the end of the pandemic, or are you seeing that people in positions like yours are now moving back towards the Southern Californias of the world instead of staying in Coeur d'Alene?
I don't have good numbers on that, but anytime you have 25% growth, that's just unsustainable.
That's
It
Go ahead.
has, but it's still positive growth out here. I think, like you said, the pandemic markets, it really put Coeur d'Alene on the map a lot more. I'm staying here, I'm digging in. Some people that maybe had remote jobs that are no longer remote, those are really the people I'm seeing move out of here. But otherwise, I still see a lot of families trying to move out of here. The branding and values of places like Coeur d'Alene and what they have, that is still attractive to a lot of people. And some people maybe couldn't move during the pandemic. Maybe they're locked into their job or something and needed to get them 2 to 3 to 4 to 5 years to get out. Now they can finally move. One of the other reasons why I like Coeur d'Alene a lot is like the whole city's wired for fiber internet. I'm on a 10-acre farm kind of outside the city a little bit, but I have fiber internet here. I also have Spectrum. And because I need to be on the internet for my job, I also have Starlink. This whole hybrid remote work thing has been just fine for me. And I've made the investment to make sure that I can stay connected to my clients.
That makes a lot of sense. James, you ready for the best ever lightning round?
Yes, sir.
What is the best ever book you recently read?
The Bible. I think the Bible is the story of us as humans in a civilization and has a lot of God's wisdom in it. And I think a lot of books that have been written over the past 3,500 to 5,500 years still reference a lot of things that you can find in the Bible.
Does the Bible qualify as a book that you read recently?
If you read it every day, does that count as recently?
Yes, we'll take that. It's about a 72-hour read. And there's a book called The Story that breaks that down to somewhere between 15 and 20 hours that follows the chronology of the stories in the Bible. But yes, if you read it every day, I'll take that.
The other one I just finished was Ego is the Enemy by Ryan Holiday, which was amazing. Other than the Bible, this is one of the only books where I feel like I'm going to have to pick up every couple years.
Gotcha. As long as the Bible is something that you've taken to recently, I'll take that as well. But I'm a fan of Ryan Holiday too. What's your best ever way to give back?
Best ever way to get back is I do a lot of community events here in Idaho. So for example, at our lodge, we started a farmer's market, and that's just been a great way for people to come out and support their own small businesses. I feel like with my career as a tax professional, keeping money out of the government's hands is a great way to give back. It's a career passion for me when I can keep money in people's hands without giving it to a government who's going to spend it on whatever ridiculous stuff they want to spend it on today.
James, on the deals you have done as an investor, what is the biggest mistake you've made and the best ever lesson that resulted from it?
So my grandpa gave me some money to invest in the stock market, say 10 to 15 years ago. And through that process, I realized I'm not a good stock market investor. I got too addicted to the highs and lows of option trading. I grew a portfolio from around 20K to 65K, trading a lot of options, and then cashed out the principal to start some businesses, but then lost the rest. So I realized through that lesson that I'm going to stick to hard assets and developed an investment philosophy I call Swagger, which stands for silver, weapons, agriculture, gold, entertainment, and real estate. The Swagger investment philosophy.
On that note, what is your best ever advice?
It's hard to think of what the best ever advice is going to be from a business perspective. I'm going to use a quote that my grandpa had in every one of his emails, and that's be kind because everyone is facing a hard battle. When you're in business, when you're dealing with people, just always try to think of where they're coming from. There's a book I think it's called Getting to Yes, in which you really think about what the other person is going through and what their needs and wants are. Being kind, if you can meet their needs and your needs, that's a win. That's what I'm all about. I feel like that's what capitalism in America is all about as well.
Last question. Where can people get in touch with you?
So you can get in touch with me at thehotelcpa.com. We're going to be raising a hospitality fund to target some of these assets that need operational and physical value add in the mountain states of Idaho, Utah, Wyoming, and Idaho.
That link is in the show notes. James, thank you. Best ever listeners, thank you as well for tuning in. If you've gained value from this episode, please do subscribe to our show. Leave us a 5-star review and share this episode with a friend you know we can add value to through our conversation today. Thank you and have a best ever day.
Thanks for having me on, Slocomb. Hope you all have a best ever week as well.